a lot more on the IT sector as well. But to discuss a lot more about this, we're now being joined by Sandip Agarwal, the fund manager and co-founder of Sowilo Investment Managers. Sandip, very good afternoon to you. Thanks so much for joining in. It's a space that you track very closely. Let me first start off with Infosys. What do you make of the company's potential announcement of a buyback meeting on September 11th, as well as essentially the timing of it as of now?
Hi, so good afternoon and thanks for having me on the show. So since we run a PM as a disclaimer that I am not recommending any stock or anything, it is just a view. So basically, if you see the whole industry, the IT industry that generates tons of cash, and they have been generating significant amount of cash year after year after year after. So there are only two options to use that cash, either distribute it through dividend or buyback. And the capex requirements are very minimal, so there is no choice with this company but to come out with regular dividends and buyback. And I think that is what Infosys is also trying to do. And I think that the numbers which already have been discussed on the screen, it should be around that 2-3% of the market cap, so maybe 13,000-14,000 rupees is what they can come. It can be a little bigger also. Because right now there is no immediate use of such huge cash balance, so it is best to return to the shareholder, and it unnecessarily also depress the ROE of the company because the ROEs look less because of huge cash balance in the balance sheet.
Okay, so Infi seemingly going to be biting the bullet first, Sandip, and very good afternoon to you. Would this mean that the other large companies also will follow suit, and what is the view then from that perspective? Because the challenges that they're faced with, they don't go anywhere. There's still a question mark about the discretionary spending in the United States, about the health of that economy, and heading into the rest of the financial year as well. So this is probably one trigger. Let's talk about that first, and then what you make of the rest of it.
No, so the real challenge is that, we have penetrated very deep in the outsourcing space already in US. Almost whatever could be outsourced, most of that market share is already with Indian IT companies. So how much more you can gain? So this and the size which Indian large IT companies have grown to, the scope to grow at double digit is very limited. So this industry, for the large cap perspective, has become a X growth kind of industry where growing at more than 5-6% will be really challenging. If 1 year there is no growth, next year you can see 10-12% growth, but the average will remain 5-6% kind of growth. And some benefit of rupee depreciation, so profit growth could be 1-2% higher, but not more than that. And for that, the PEG ratios which the industry is commanding is between 4 to 8 times, which is little expensive. So I think the only rationale which happens in the IT sector, large names, is that either you look at them as defensive and should give better returns than the FD returns, or you replace them with FMCG to some extent, because FMCG with same growth is trading at 30-40% premium to them. So a fund manager may choose to shift from FMCG as a defensive to IT. That is the case. Second, they are relatively lesser valued than the FMCG. Otherwise, from a PEG ratio perspective, they are not cheap at all.
Got the view, Sandeep, and largely that has been one of the key issues, right? Over the last 2 years, the growth has been really depressed for all the large cap IT peers, while we started to see that not so much of a revival essentially in Q1. Post Q1, we've seen some deal wins starting to come in, which are sizable for the likes of TCS amongst others. How are you viewing that in context of what's happening currently with generative AI amongst others? Do you see that over the next couple of quarters, to say the least, we might see the deal win momentum starting to inch up again for all these large cap IT peers?
So, deal wins get announced on and off, but the problem is that the deals are over a period of 3 years, 5 years, 7 years. So, you really cannot make out whether they will really change the revenue growth trajectory, number one. Number two, remember that, we are going through a disruption phase, which we have gone through 7-8 times in last 30 years. But in the past, all the disruption phase, the key point was that, we were transitioning from one technology to another. So you have to retrain your workforce, reskill in the new technology, and you can redeploy them. So the growth used to get bundled up and come back. So never ever, there was a reduction in the work. But if you see with generative AI coming in, what has happened is that, the efforts are going down by 20 to 30%. Now, if your effort are going to go down by 20-30%, you have to make that up with more work and also realization improvement, which looks tough. So what is happening, total IT spend may not go up substantially if you include hardware, software, everything. But for last 10, 15 years, all this spend, everything from hardware was getting reallocated to services. And now this is the first time in last 1.5 years, we are seeing some allocation happening from services side to the hardware side in buying the GPUs and the servers. So overall spends are probably still going up, but the allocation has changed after 10, 12 years in a very different way. So I believe that, we will have growth challenges for some more time to come. Once that great reset happens, I don't know when it happens, 4 quarters, 6 quarters, either in terms of valuation or in terms of growth coming back, then probably, the sector will again come back into flavor. They are doing incredibly good job. They are doing phenomenal job. They are generating tons of cash, but it is an industry disruption which no one can survive, and everyone will take time to, recoup to that.
From the perspective, and point well made, Sandip, but from the perspective of investors and watchers standing from the outside in, the question is, of course, and you've already talked about the fact that they've penetrated quite a bit with regard to the outsourcing activity. And so from that perspective, if they're sitting on as much cash as they are, why not use it for inorganic growth and bolster revenue sources from other areas which they're not utilizing right now? Or does the opportunity not exist in your opinion?
So inorganic acquisitions, if you see, even Accenture keeps on doing every year 10, 15, 20, but they are minuscule size. So those are for skill set or some entering in some market that even Indian IT companies keep on trying doing small, but otherwise large acquisitions you can't do because there is no successful case in Indian IT services space for a large acquisition to be successful. Means Tech Mahindra has tried many times and many other players have tried. Except for Satyam Tech Mahindra, in that case, Satyam was available at a reasonable price, so they made some good money out of it. But otherwise, large scale acquisitions are very difficult in IT because finally what you are paying is to get some people which you can any which way hire and, some foot in the door in some clients, some markets. And also for that paying billions of dollars, I don't think how fruitful it is. Then secondly, the exit, the key man do exit after some time and all those challenges happen. So I think, large acquisition in IT services is very difficult to integrate, execute and make a positive return. No one has been able to do it. And I think small skill-based, all of them are doing when they get an opportunity. So I think it will remain a small skill-based acquisition, market-based acquisition, geography-based acquisition thing, and not a large one. You can't deploy big cash in those acquisitions. So I think inorganic has its limitations for the space.
Got that, Mr. Agarwal. Just last question from my side. Essentially, we've seen, we discuss about deal wins, we discuss about acquisitions and the cash that they hold. What would be your, pecking order to say the least? Would you prefer having that exposure towards mid caps where the growth is higher, but so is the valuation? So how should investors, according to you, look at this aspects to close out the discussion? Because while the cash is one of the major positives for large cap IT players, the growth has largely been missing for the third consecutive year, essentially, if that happens in 2025. So what could be your pecking order according to you?
So see, I will give you a theme. Basically, what is happening, a lot of deals are coming in the new technology, that is AI and all. But the problem is that till 2019, what was happening, the deal sizes were big, whatever disruption was happening. So, large caps were the first to benefit. After COVID, what has happened, that deal sizes have collapsed by 40-50%. People wanted smaller deals, quick turnaround. And that is the reason you would have seen that mid caps like Coforge, Mindtree, LTI, LTTS, so many of them did phenomenally well from 2021 to 23. They went up like 8-10 times in that short span of time. So they got massively rated. I think this time the disruption which is happening, the deal sizes are even 40-50% lower from that size. So while everyone is chasing those same deals, everyone has the capability, everyone is able to probably execute also. But it will, if you take the whole scheme of things, it will take lot time before the composition of the business for large cap to change to reflect that growth, and it will take even some time for the mid cap. But small names which are very, very small in size, for them getting this 50,000, 100,000, 200,000 contracts and changing the number of revenue could be, the probability is better. So I would say that thematic perspective, I think this is the time, this disruption will make very, very small companies big very quickly in terms of value creation, rather than, mid cap or the large cap. So this time we are looking at more very small names and not mid and large names. That is the way we are approaching and looking at the space.
All right. So we have to do our own research. Thanks so much, Sandip, for getting us this chat and perspective. And I guess that means we have to do a little bit of legwork on our end to get our viewers that perspective. All right. It's time for a very quick break. Just a quick reminder.